Hey guys. So in the next few videos as part of the new intraday trading series, we will be going through some more advanced concepts that not only help swing trading, but can be applied to intraday trading techniques as well. Again, we want to state that intraday trading involves a higher level of risk as it is more fast-paced and does not follow the traditional rules we have established in this course. You do not have to use these new methods and can stick with the swing trading safe methods we have previously shown. But this is up to you. As you grow as a trader, you decide for yourself what kind of trades you want to take and what kind of trades you want to skip. In this video, we will be going through the concept of RSI in combination with divergence, the 14 EMA and the 50 EMA cross, and the concept of scaling in. We don't like to start traders with indicators because that causes bad habits. But now that you have made it through the material, we start bending some of the rules. Again, we don't use any of these indicators on their own, but we combine them with price action concepts we have already established. First, on your charts, add in the Relative Strength Index, or the RSI for short. Right-click, click Insert, Relative Strength Index, and it should pop up along the bottom. Next, add in the 14 EMA, same thing, right-click, Insert Indicator, Moving Average Exponential, and make sure you have it set to 14. So the RSI indicator is used in the incorrect way by 90% of traders. What most traders use it for is by using it as an indicator of overbought or oversold levels, meaning they use it to try and spot reversals. As you can see, when this line crosses this horizontal line, it is an indication of overbought territory. So they believe price should reverse. When this line crosses oversold territory, they believe price should reverse upwards. This looks picture perfect right now, but that is because you don't know where the top or the bottom is in that particular moment when the RSI crosses. The problem with using the RSI indicator like this is that in a trending market, price can stay overbought and oversold for a very long time, meaning you'll get a lot of fake signals from the RSI indicator. So we figured out a way to use it in a discretionary fashion, which is through divergence, but not in the way you think. So divergence is when there is a discrepancy between price and the indicator. So at these 2 points here, price is making a lower low, where on the indicator, price is making a higher low. And then as you can see, price reverses upwards. At the top here, price is making a higher high, where on the indicator, price is making a lower high, and it reverses downwards. Down here, price is making a lower low, where on the indicator, price is making a higher high. Reversal. Again. And again. So now that you know what divergence is, let's add some filters to this for how we use it more effectively. Here are two things that make divergence even more effective. It's better if the divergence is occurring inside or close to overbought or oversold RSI levels. And secondly, the wider the swings, the better. If you look up here, notice how we have divergence. This is a tight divergence. Notice how close together price is. Now, here is a better divergence, which is what we call a wide divergence. This gives us an early indication of a possible trend change. So now, let's layer on some price action on top of this. We notice this decent level of resistance, but the main reason why we even consider this level of resistance is because of the long wicks rejecting this level over and over again. 3 long wick rejections at this level. Next, notice what pattern this was making. It created a rising wedge, which is a bearish reversal pattern. So all of this is great, but still it does not qualify an entry. Because as always, we need some kind of breakout to show that momentum has started. So let's jump to the 4-hour. Here on the 4-hour, once this breaks, as always, we have no idea what comes next. We just know that this is going down. So as always, in situations like this, you have 2 options. If you're aggressive and you just want to jump into it right away because you don't want to miss the trade, you would set your entry on this momentum candle, and you want your stop loss to be protected in case of a pullback. So you want to keep it above the 50 EMA. Remember that the pro of this trade entry is that if the pullback doesn't come, you are already in a great trade. The cons of this kind of entry is that you risk a pullback occurring, which is the reason why you need a wide stop loss on these kinds of entries. Option 2 is the ideal entry, which is the pullback. And this one was picture perfect because it came up, rejected the broken trend line and wedge, rejected the 50 EMA, and made a perfect red rejection candle where the wick is sticking out. The pros of this kind of entry are that you get in at the best price and you can put a tight stop loss in. Again, you put the stop loss above the 50 EMA and not too tight either because you don't want to choke the trade. So there are many ways you can manage a position like this. 1, you can set a 1 for 2 or 1 for 3 risk reward on this with an automatic close. Option 2 is once 1% target is achieved, move the stop loss to break even to catch the larger move. We don't know how far down this will go, but since your position is risk-free, after you move the stop loss to break even, worst case scenario, you break even. Best case scenario, you have this one monster trade running, banking you money. And remember, in the meantime, you are still trading other pairs. Now, here is how we take this trade to the next level. Price starts to pull back, and if this was indeed a true reversal, and not just a pullback, this would have made a higher high, but instead it failed and made a lower high, signaling that this could just be a pullback. But we still need confirmation. The confirmation occurred through the break of this trend line, which was our signal that the trend would continue down. So this is the power of scaling in, because you already have an open position short that is risk-free, and you risk another 1% while you already have an open, risk-free short trade. What this means is you are using the 1% profit that you have on the previous trade and risking that on this trade. Meaning if this trade goes against you and you lose that 1%, you still have the 1% you're gaining from your current open position. Worst case, you break even. Best case, you have 2 monster trades running, which is the foundation of risk reward. Remember that we already have a direction bias from the dynamic reversal combo price action up here, and we are riding the momentum down. So after we had this break of trend line, you are again faced with 2 options. Enter right away at this candle close with a good stop loss above the 50 EMA and the trend line, or wait for some kind of pullback. And we had a small pullback here occur that rejected this level of minor resistance before the trend continued down. So to add even more confidence to this, we use the 14 EMA as a confirmation tool of the price action we have already established. So we drop the 14 EMA in. And notice how when the 14 EMA is below the 50 EMA, we are in a clear downtrend. When the 14 EMA breaks above the 50 EMA, we started a short-term uptrend. And here the 14 EMA broke back below the 50 EMA again, confirming our already established price action. We don't use indicators on their own, but only to add extra confirmation to what we have already established with price action. So this candle rejected this level of minor resistance and the crossed 14 EMA. So we put our stop loss above both EMAs and the trend line, and this thing ended up being a monster. You now have 2 running positions open, banking you big percentages. And the key factor is that they're both risk-free. And you can continue to manage these on the way down through trailing the stop loss. Here's the thing. You entered these 2 great trades, but are still trading other pairs while you have these 2 positions open that are risk-free. That's how powerful this concept is. This was in reality 1 swing trade entry, but you milked it for more. This is why trading more does not mean more profit. And let's say you banked 10 to 15% on this 1 trade. Even if you take another trade and it is a loss, your risk is always capped at 1%, meaning you manage your risk and let your winners ride and add to them. How you manage trades is just as, if not more important, than your actual trade entry. So let's take a look along the bottom where price ended up. So you notice divergence here, but it is tight divergence without the wide swings we like to see. Now this next divergence was wide divergence. Notice the size of the swings and the non-tight price movement. It also occurs right at a level of support, which had multiple rejections in the past, which is another confluence factor. And again, we always need confirmation. So you also notice that this is a falling wedge pattern. And the reversal is confirmed through the break of the wedge and making a higher high. Again, you have 2 options. Either you enter on this engulfing candle with a stop loss below it, or you wait for a pullback, and as you can see, the pullback never came because of the huge bullish momentum. You always have 2 choices. Also, you notice this level of resistance here. So once price gets there, you move your stop loss to break even in case price pulls back. And now you have another risk-free position, and you can start trailing your stop loss up. This is specifically why signals don't work, because all traders are different in their decision making in terms of where to enter, how to manage their position, but more importantly, their risk tolerance and current running profit. Meaning, let's say you just banked 10 to 15% on a massive trade. You might feel more confident and jump into the next trade with the breakout engulfing candle without waiting for a pullback. Again, you're only risking 1%, so your risk is capped. Let's say another trader just came off of a loss on some other trade. So when they spot this one, they want to wait for a more secure entry, meaning waiting for the pullback, as they probably wouldn't want to trade the aggressive breakout. All situations are different for all traders. Trading takes discretion, and you should use everything we've taught you to develop a style of trading that suits you best. So let's do this again, but to show you something even better. Now, weekly divergence doesn't happen often because of how long weekly candles take to form. But when you do get weekly divergence, those trades have the potential to go on and become monsters. Look at this up here. We have a very wide divergence on the weekly time frame, but we also had momentum candles, which we didn't like. But as always, we need to confirm this divergence on the lower time frames for an entry. So here in the daily, you also have price entering into overbought territory on the RSI indicator. And again, still no entry. we need some kind of price action to confirm our bias. So let's jump down to the 4 hour. Here in the 4 hour, we also had divergence. But still no entry. The entry occurred through the break of the trend line and the pullback to reject the 50 EMA, and more perfectly, the fact that the 14 EMA crossed the 50 EMA right at the pullback, which further confirms our analysis. Remember that the 14 EMA has been above the 50 EMA for months now in this bullish trend before finally crossing. Again, these indicators only confirm what we have already identified through price action. So moving forward, as price came down to this level of support here, we noticed momentum loss and multiple long wick candles. So jumping to the daily. Here in the daily, we had divergence again, then a higher low, which also makes an inverse head and shoulders pattern, and confirms our weekly bullish bias. Now again, this is why discretion comes into play, because there are so many ways to enter this trade. You could have entered right on the right shoulder on the daily time frame and set your stop loss below this area here. We entered a bit differently, which is more risky, but is our style. So this is what we saw. After we made this inverse head and shoulders pattern, we noticed a higher high, but we still wanted to see some kind of pullback so that we could get in at the best price with this fresh uptrend. So what we did was we used the 30-minute time frame. And as you can see, this is where the pullback downtrend is occurring. Once price broke above the 50 EMA with a momentum candle, and then the 14 EMA crossed, we took a trend following trade with a wide stop loss for 1-for-1. This is not something we suggest, but is a very discretional trade entry, meaning we gauged all factors and decided on a move that best suited this situation. So let's jump to the Euro Aussie to discuss why we have had this on our watch list. As you can see, we had daily divergence down here, right before the trend change. So jumping to the 4 hour. As confirmation, you had a break above the 50 EMA, the 14 EMA crossed the 50 EMA, price pulls back to reject the 50 EMA, not with a long wick candle, but with a bullish green candle, and it bounces. This would have been a good, quick intraday trade. So here's another trick. If you didn't like this candle here as a rejection, go down to the 1 hour time frame and wait for a break of this short-term trend line to confirm that this pullback is over. So here we are right now. We do not have good daily divergence, but jumping to the 4 hour, we have a decent divergence. This is why we wanted a clean break of the 50 EMA and a pullback, because this trade is not of high quality. The only reason this is on our watch list is because of the weekly. We had a long-term trendline break and are coming up to this level of resistance, but the daily and 4 hour time frame does not have good price action. There is a lot to consider when looking for trade entries. It is not always black and white. You have to apply these techniques on the charts and figure out what kind of trades you want to take and what kind of trades you want to skip. So in the following episodes, we will dive deeper into these concepts and show you how to apply these strategies to the intraday timeframes for quick moves. These trades will be riskier, but present more trading opportunities on an ongoing basis. So thanks for watching, and I'll see you in the next episode.